What is an assumable loan? How does assumable mortgage work? And most importantly, how can it benefit you? Well, I thought you'd never ask. Hi, I'm Lydia Rowe, a realtor here in the Dayton area of Ohio, and on this channel, we talk about all things living in the Miami Valley of Ohio. Today, we're going to explore a very strategic and underutilized tool in the current housing market, and that is assumable loans, or an assumable mortgage. If you're thinking about buying or selling a home, or you're a fellow agent, understanding assumable loans can give you a unique advantage in today's market. After I explain what it is and how it works, I'm going to give you an example of a house on the market today that you could take advantage of. I realize that you might find this video long after that listing is already sold, but it's still a great example of how an assumable loan could work to your advantage. Finding a house with an assumable loan takes extra work and there's extra steps, but the payoff can be massive. How would you like to save an extra $400 a month on your house payment? Yeah, that's what I thought. First things first, what exactly is an assumable loan? An assumable loan is a type of mortgage that allows a new buyer to take over the seller's existing loan. Instead of applying for a new mortgage, the buyer simply steps into the seller's existing terms, payments, and balance. You can even take over a VA loan, even if you're not a veteran. If you are a seller with a VA, FHA, or USDA loan, you'll want to discuss with your mortgage company all the ins and outs. Sounds interesting, right? But how does it work? The process begins when a buyer agrees to assume the seller's mortgage. Both parties must then get approval from the lender, who will evaluate the buyer's creditworthiness and ability to assume the loan. Once approved, the buyer becomes responsible for the remaining mortgage payments. The seller is then relieved from the debt, and the buyer continues to pay off the loan under the original terms. Now, usually the amount the seller had in escrow also transfers, so you'll need to work that out and take that into account with your offer, as essentially the seller will be losing that money that otherwise would have come back to them at the sale. Also, if you have a VA loan and someone who isn't a veteran assumes your loan, you might have to be okay with giving up your VA entitlement. Again, lots of spinning wheels here, so you need to get all the details of your particular situation to know if it's going to work for you. Now that you know what an assumable loan is and how it works, let's talk benefits. One, lower interest rates. This is the main advantage and why I'm talking about this in our current market. Since interest rates have risen significantly in the past couple years, assuming a loan that originated when rates were in that 2 to 4% range can be significant savings. Two, fewer closing costs. Assuming a loan often involves fewer closing costs compared to taking out a new mortgage, as some of the fees are bypassed. Now, this might not be the case if you need an additional second mortgage, but if you have the cash to cover the remaining balance and can afford to just take over the loan, then you can save in closing costs. Three, faster transactions. The process can be faster than applying for a new mortgage, meaning quicker possession of your new home. Now keep in mind that I said it can be faster. With extra hoops to jump through, I have heard of some folks who say the process can be a little bit longer than usual. Four, less time on your loan equals more of your monthly payment goes towards the principal. You're assuming the loan as it is, so instead of re-amortizing for 30 years like a new loan, your payment starts where the seller's left off. So if they only have 20 years or 27 years of the 30-year amortization, that's what you get. The nice thing about that is even only 3 years into paying off a mortgage, more of your monthly payment goes towards your principal and less towards interest. You pay the most interest on your mortgage on the front end, so if you assume the seller's loan, they took that hit for you, and you'll be able to build equity quicker. The less time left on the loan, the more significant that savings, but also the less amount that transfers at that lower rate. Now you might be thinking, I'm in, this sounds great, sign me up, but how can I find an assumable loan? Now this one's a little more tricky. There's a box your realtor can check when they enter your listing into the MLS, but there's not an easy way to search for it. This is going to take a little sleuthing on your end. When you find houses you're interested in, ask your realtor to find out if the loan is assumable, and if it is, what the rates are. You'll need to have a conversation with the original lender to see if you qualify and go from there. Let's break this down with an example. The house I'm looking at is located at 205 Nicole Court in Dayton, and it's currently listed at $347,000. Let's say there's $175,000 left on an assumable mortgage. Now, one pretty large caveat to assumable loans is that you need to have the cash to make up the difference between the amount of the loan and the purchase price. So in this case, if you were going to pay full price, you'd need $172,000 in cash. I know that wipes out a lot of buyers on the market, but if you've saved up to make a cash purchase, or if you've recently recently sold your house and cashed in on that equity, and you are planning on rolling that over to your next house, you're in a sweet spot for being able to take advantage of an assumable loan. But just how much can you save? If you originate a loan today, at the time of this video recording, you are looking at rates between 6 and 7%. For the sake of this example, we'll go right in the middle at 6.5%. On a loan of $175,000 for 30 years, you'd be looking at a monthly payment of $1,106.12. If instead you assumed the seller's current loan at 2.25%, your payments would drop down to $668.93. By assuming the loan at the lower interest rate, you save around $437.19 each month. That adds up to an incredible $157,387.81 over the 30-year life of the loan. So as you can see, assumable loans can be a powerful tool in your financial arsenal, especially in a market with fluctuating interest rates. Of course, not all loans are assumable. It's typically limited to FHA, USDA, and VA loans. And sometimes there's risks involved, like taking over an upside-down mortgage. Every situation is unique, so consult with a financial advisor to see if this strategy works for you. And if you happen to be looking in the Dayton area in January or February of 2024 and liked those numbers I shared, reach out. I just might have the perfect house for you. If you enjoyed this breakdown and you want to see more content like this, hit that like button, subscribe, and share your thoughts in the comments below. See you next time.